One stock that is in focus on the back of earnings is a persistent system. The results have met the street estimates. However, the dollar revenue has seen a sequential growth of around 4.2%. Deal wins have been strong. The con-call commentary from the management has also been strong. But let's also welcome in Sandeep Kalra, CEO at Persistent, to understand more. Mr. Kalra, welcome to the show. My first question coming to you is the street wants to know the kind of growth that you've seen in the fourth quarter. Is that trajectory expected to continue in terms of FY26 as well?
Yeah, good morning. And first of all, thank you for having me. Let me just summarize the quarterly and the yearly thing, and then I can build on it for the future. So as you rightly said, we delivered $375.2 million. On a sequential basis, this is 4.2% quarter on quarter and 20.7% on year basis in growth terms, in dollar terms. Now, if you look at the full year, we achieved 1.409 billion. That gives us 18.8% year-on-year growth. Now, if you look at the last 4 years, our CAGR, compounded annual growth rate, translates to roughly upwards of 24%. If you look at the order book has also been fairly healthy. There are macro headwinds that are there on the horizon, and one only wishes that these tariff-related discussions, the DOGE discussions, and all of these things kind of settled in. And even with the environment being tough, the IT services industry has a good opportunity in terms of helping our customers do the cost optimization part of it. And several of our deals over the last 2-3 quarters also have been cost optimization led. So we are optimistic. We are cautiously watching the macro. But if you look at the order wins, if you look at our growth trajectory, it should bode well for a relative outperformance in the sector going ahead as well.
Mr. Kalra, good morning and thanks so much for joining in today. It's Puneet this side. I just wanted to, go across the business and just look at the segmental performance as well. While banking, BFSI essentially as a vertical has done decently, I was going to just talk about an emerging segment for you, which is healthcare. Now, across IT majors, we've seen that for healthcare, there has been some conservative commentary in terms of what's happening on the ground. If you could just fill us in for you specifically, how is that vertical looking at right now? Is this an opportunity for someone like you who's building on this vertical over the last few years, and now is the time to hit the nail on the head? Anything that you can give us with client commentary? Has there been some delays? What are you looking at the ground?
Sure. So if you look at the bigger picture for Persistent in healthcare life sciences, for us, this has been, if I look at the full year basis, it has been a 33% plus growth on a year-on-year basis. If we look at the vertical for the last 6 quarters, this has been the vertical that has been kicking in high gear for us. And for the last quarter itself, if you look at it, the quarterly growth was led by BFSI, which was 5.9%, high-tech and emerging on a quarter-on-quarter basis was 5.2%, and healthcare was 0.6%. Now, a number of the initiatives that, if you look at the DOGE side of it, the USAID side of it, and so on and so forth, they are basically clamping down on the spend that is there in certain parts of the ecosystem. The government-funded payers, the research organizations that do a lot of clinical research, and otherwise the spend in the human health services and so on. So there's a bit of clampdown there that may impact the growth rate for certain quarters. But overall, if I look at the entire ecosystem across scientific instruments, medical devices, pharma, payer, and provider, we are reasonably confident over the year it will pan out in terms of good growth for overall the industry and for Persistent within that.
Mr. Kalra, if you can also just comment on, a lot of the upcoming healthcare as well as vertical companies in the US as well as the developed economies, there was a lot of funding essentially from, agencies as well as governments. And we've seen, like some pressure there, at least in the US from DOGE coming in as well right now. What is happening with those kind of companies? Is it, that the spending for them specifically has now been delayed because they are largely funded by the government, and anything that you can fill us in at least in that aspect?
Yeah, sure. So you are on the right track. There is a significant amount of cut down that has happened on the research organizations. So, for example, various universities in the US, they were conducting clinical research, not only in the US, but even in countries like India, that was funded by the government through USAID or other funding programs. That has been clamped down. There is a certain impact of that on the full value chain. So if, for example, these universities or NGOs were conducting, let's say, clinical research, they were consuming the products from scientific instruments and diagnostic companies, they were buying software from enterprise software companies and so on. So it does have a ripple effect, but over a period of time, all of this should settle down. And overall, if you look at the US economy, The healthcare spending is a big part of that. And this is a secular spending. People need healthcare in a good economy or bad. So this sector will settle down with these adjustments, and it should, in a few quarters, come back to reasonable growth for all of us.
Right. Mr. Kalra, then overall, if you have to look at the tariff impact as well, let's take sectors like communication, energy, utilities, manufacturing, logistics, retail. All of this put together, would there be pressure on any of these segments, and in turn, there could be a risk to the kind of targets that you have for FY 26-27?
Sure. So first, a clarification for you and your viewers. The three major segments for us are tech, followed by BFSI, followed by healthcare life sciences. We don't have a big play in manufacturing or in retail or in energy, utilities, and so on. Having said that, even within the sectors that we play in, if there is a cost pressure, that's another reason for our customers and prospects to work with us to contain the cost, both by offshoring and by using the platforms that we have built on AI part, which can help do the same work for lesser expense. So we have a software product engineering / application development maintenance platform called SASVA. So overall, even if the cost pressures kind of go much bigger from where we are, that should bode in a reasonable way well for us, helping our customers and prospects optimize for the newer regime that may exist in the newer kind of tariff or other scenarios.
A follow-up with all of this is in terms of the kind of discretionary spends, client spends that you're looking out for. In terms of a conference call, you categorically mentioned that things have been fluid. However, you've not seen any cancellations in terms of orders or deals. There is a slowdown as of now. How would you want to explain that to the viewers and investors? I mean, slowdown in terms of deal wins or slowdown in terms of spends, in terms of execution? How would you want to put that?
So the slowdown is in decision making for the forward looking part.
Okay.
Every company has a business to run. Whether you are in whatever sector, small or big, you're serving your customers, you're trying to become better compared to competition and so on. So you don't stop running your companies. You look at discretionary spend, which is a good to have spend. And we have very clearly said that Persistent is not necessarily, a discretionary spend oriented company. When the going is good, yeah, we do help our customers in their revenue enhancement initiatives. And when the going is not good in terms of the macro being tight, we are right up there in terms of, helping our customers with the cost equation, whether it is doing vendor consolidation, more offshoring, bringing more technology to optimize for processes using AI or otherwise. So we are fairly confident, whether it is a good, upturn in the economy that happens over the next several quarters, or even if it remains soft, we are confident of growth, which will be a relative outperformance to the industry. And as I said, in the last 4 years, if you look at our CAGR, the compounded annual growth rate, it's upwards of 24, more like 25% plus, whereas the industry has grown less than 8% in the same, CAGR parlance. So we are relatively confident. Good or bad macro, we'll adjust and we'll work closely with our customers to deliver value to them.
Mr. Kalra, just one question, on which we've seen in deal wins as well as, your clients which are over 5 million. Now, if I see FY24, and you highlighted this in the presentation as well, your count for more than 5 million clients went from 38 to 40 in FY24 in the 4 quarters. In this year, it's gone from 41 to 55. What has been one of the key changes in this aspect? And I'm sure there has been work going on over the last 5 years on this, but specifically, is this largely in BFSI that the 3 segments that you highlighted in, and what can we expect over the next, at least the next 3 to 4 quarters on the large client deal additions?
Yeah. So if you look at the last several years, and just building on what I said earlier, our compounded annual growth rate has been in range of 25% for the last 4 years. The industry has been growing at less than 8%. What that means is we have been garnering market share from our competitors for the new business that is outsourced or the renewals that are happening. That is clearly reflected. Now tie it up with what you just said. Our count of customers greater than $5 million has increased. Our customers greater than $75 million, we have 4 customers today as compared to an year back where the number was lesser. So overall, we are getting market share, gaining market share against our competition, both from our capability perspective, whether it is GenAI led or otherwise. GenAI revenues are about to pick up. It is also leading to a lot of data modernization projects. So overall, the capability led growth, that we have, and our customers, based on our quality of delivery, they're giving us more business. All of that is there. Now, we don't give forward-looking guidance, but if you were to extrapolate our last several years' growth and the order book that we have given, it should bode well for us.
Last question, Mr. Kalra, coming from my side is 8 quarters to reach the $2 billion mark is what you're seeing. $5 billion in terms of revenue by 2031, a 250 basis point margin improvement by FY27. To achieve these three, yes, you will see acquisitions that could come your way as well in the BFSI space. What is the kind of timeline that you're looking at, number one? I'm sure you're not going to speak to us about what are the potentials, but the timeline and the size of the acquisition that could be in the offing from a persistent and any other segments that will drive growth.
Sure. So first of all, let me work the things on the margin side first for you. So if you look at the full year, last year, if I look at FY24, we were at 14.4% range, 14.4 to 14.5. This year, full year, we were at 14.7, but our exit quarter was at 15.6%. That bodes very well for us because that gives us a starting base of 15.6%. So on a full year basis, we are already having a head start on margin improvement. If we keep the operational discipline, if we grow consistently, then margin should give us the uplift that we want directionally towards where we want to build. Second, if you look at where we delivered the Q4, we delivered $375.2 million. You multiply that by 4, it is $1.5 billion. Halfway, we are already there. We have 2 years. Last 4 years, CAGR is 24%. Even if we were to deliver lesser than that, the $2 billion is line of sight, give or take a quarter here or there. That is the second part. Third part, we have never said about any acquisitions. So I don't know where you got the BFSI acquisition, but we have just said our acquisition strategy is threefold. We want to expand in Europe. We may do a reasonable size acquisition in Europe. We want to build on our capabilities, whether it is AI, Gen AI, or otherwise in domains in our verticals that we play or sub-verticals within the US. That is the second part. And third part, there are horizontal use cases like the contact center acquisition we did with Starfish. So those are our acquisition criteria. We are at any point in time evaluating acquisitions. If there is anything, we'll come to you and to your viewers and announce them. So that is where it is. And we are reasonably confident within our organic and inorganic part. The $2 billion is line of sight and we'll build it up to 5. We have 5+ years to deliver to it. And we are, if you look at our history, track record, we are confident we'll get to there.